Hi there, my name is Andy Farquharson and I'm your host on Alternative Exit.
The podcast dedicated to educating small business owners about the possibilities, benefits and challenges of transitioning to an employee ownership model. Did you know that there are over 200 million SMEs around the globe with an owner that will be retiring within the next 10 years? Many of these owners will never actually find a buyer for their business, forcing them to close their doors, wreaking havoc on their employees and the communities. There is an alternative. This show will explore different forms of employee ownership and the best practices for a successful transition. Each episode is going to feature interviews with experts on employee ownership, business owners who've successfully made the transition, and consultants who've helped facilitate these changes.
Okay, now let's get on with the show.
Hello, everybody, and welcome to another episode of The Alternative Exit. So today's guest brings a rare blend of investment experience, deal-making insights, and a deep belief in employee ownership. Michael Morosi is the co-founder and managing partner of Southeast Acquisition Capital, who we've heard about before on this podcast, where he really focuses on the lower mid-market and applies those private equity principles to broaden employee ownership buyout. He's also the co-founder and MD of 40 Million Owners, who you've heard with one of his other co-founders, Mike Brady, earlier. And to keep the podcast family alive, he also serves as the Chief Investment Officer of LS. And we interviewed their CEO, Eric Strickland, a little while ago. So, Michael, welcome to The Alternative Exit.
Thank you, Andy. It's great to be here.
Yeah, no, we're so grateful to have you here. So you bring such a unique perspective to this. I mean, we did hear recently from Jeffrey Easterling, who sort of had that searcher mentality coming into employee ownership. I guess one of the points of conversations I had with him is that he could have gone anywhere with his career. And he sort of made certain decisions that took him down this path. But same with you. I mean, you've got a rich experience in investment banking. Your career could have gone many directions, many of them leading to sort of the larger private equity firms, sort of looking to be partners there with sort of huge payouts. I mean, why did you begin to focus your investing experience and expertise towards employee ownership?
Thanks, Andy. It's a great question. And yeah, I do think that there are some, through lines, between the experiences of the different folks that I've had the pleasure of working with here. But, I think for me, I would say two things. First, I think it goes back to the beginning, kind of where I'm from, where I grew up in a small town in Michigan, kind of buckle of the Rust Belt, if you will, and just the type of place that hasn't changed a whole lot and hasn't received a lot of investment, over the last 50 years. And so, when you grow up in that context and then you work in the global capital markets, you have this kind of dichotomy where you understand, a little bit the nature of capital, how it flows, where it flows, and also where it doesn't. And so, I think I've always had, because of that experience, both a pretty solid understanding of the opportunities created almost by disinvestment. And at the same time, the capabilities, the resilience, the intellectual and human capital that reside in smaller communities. And so I just have a deep respect for that. And I would love to kind of play a role in bringing capital and opportunities and wealth building, to places that haven't participated as much, in the last couple decades. So that's one thing. And that I think is part of my motivation. I would say second, I had this kind of what I call like my own personal employee ownership Big Bang moment. And I date it back to December of 2017, so going on 9 years ago, within kind of quick succession, I was studying an MBA in Madrid. I had an opportunity to kind of consider, where I wanted to go next with my career. I'd spent the first 15 years of my career in kind of the traditional capital markets and investment banking and asset management. And I was kind of looking for something else and basically looking almost a way to kind of bridge my experience in the markets with kind of my lived experience and my sense of the opportunity. And so within about a week, I learned of search funds, the Mondragon Cooperative in the Basque Country in Spain, and also what Pete Stavros was doing at KKR. And actually, I think I remain one of the few people who found out about Pete Stavros through his master's thesis. I actually was like, search funds, employee ownership, cooperative finance, private equity and employee ownership, private equity and ESOPs. And I come across his master's thesis from, 25 years ago now. And I read it and I'm like, this is fascinating. This is awesome. I wonder what this guy's up to now. And then I'm like, oh man, he's running KKR,
He's
and so
done okay.
I guess it
Yeah.
worked, And so basically that was kind of it, to be honest. That was just
Okay.
like, okay, well, if he found out how to do that, there's probably a way for us to do something, kind of draw a circle around all these different, kind of parts of the model and make something work. So that's
Yeah, I
that's
mean,
that's the long story.
yeah, very cool. I mean, look, Pete sort of talks about that sort of similar story of sort of growing up around that sort of real sort of blue collar background in sort of the heartland there of America. I mean, if you could just pull on that string a little bit more around that dichotomy that you experience in the capital markets, like where there is huge amount of wealth generation, huge amounts of people, and huge, like I guess the catalyst of a lot of the wealth disparity, and obviously where you sort of grew up and that tension.
Yeah, and look, I mean, I think we're seeing it play out, right? I mean, I think that is a lot of the story of this moment, And I think there are a lot of places and folks who feel like, they've kind of gotten a raw deal and they don't exactly know what or why or how, but they just look around and they look at what's happening in their families and their communities, and kind of divergent paths, over the last, just 30 years. And there's just this sense of, I think, kind of the scales being tilted against someone,
Mhm.
and I think, that manifests itself in a lot of different ways. But I think the key part is just reinstilling a sense of optimism in people and a sense of pride, in the work that they do. And, just creating an opportunity for folks to be excited and to have a narrative to their life, about forward progress. So I think that's really what it is, So then when you look at, you know, financial models, things that cash flow always have a price, right? And then
Yeah.
when you look at, the, growth, say, for example, in private credit, and when you look at the growth in just private assets writ large, and then you spend time studying the employee ownership space, and you say, wow, this is a space that has an intrinsic kind of impact story, but also has a positive spread to risk. And by that I mean there is now a whole lot of capital looking both for kind of places that they feel good investing in, but also, 10, 12, 15% returns that are really attractive on a risk adjusted basis. And so
Yeah.
like, not only do you have the, kind of the social imperative, but you have the business imperative and the business opportunity that has also been kind of enabled by the way that capital has moved from public to private. And with, and kind of the opportunity around, private credit, to deploy, really the sums of capital that folks in the space talk about needing, tens, hundreds of billions of dollars, $1 trillion, to kind of mobilize this opportunity, in the US and also globally, because this is something that resonates, I think, with a lot of people in a lot of markets, and there's a lot of overlap, with ideology, I think in a lot of places. And so that would also be fun to see.
Yeah, absolutely. I love the way that you articulate the value and the impact of employee ownership and sort of unlocking, I guess, the other side of the opportunity. I mean, a lot of when I say the other side, I mean the financial side. Like it's we hear a lot about there's a huge opportunity with the silver tsunami and all the retiring owners and the global wealth disparity, but presenting it as a really great opportunity for private capital to be allocated towards like an investment that sort of has double bottom line, right? That so has a big social impact while also delivering great risk adjusted returns.
Yeah, no, I think that's right. And I think, there are certain parallels, even with, for example, the renewable energy industry, which was an area where I spent some time, early in my career. And I honestly think employee ownership is in a similar place to where, for example, maybe the solar energy industry was in 2005, in that, returns are high, risk is low, and the appreciation for of institutional capital of the opportunity is growing. And so I think
Yeah.
right now where we're at is, the key gating factor is there's actually a limit of supply of opportunities, and a lot of work that we're doing, both on the principal investing side at Southeast, but also as an agent, at 40 million owners, is actually helping to facilitate demand for that capital. Because I think the reality is the interest and the amount of potential investable capital far outstrips the reality of it today.
Really?
And yes, I think there's actually more capital because let's put it this way. And so if you're at an institutional investor, if you're at even a medium-sized institutional investing firm with maybe a billion or 2 billion or $3 billion portfolio, to diligence an investment, for it to even be worth the time of your team, you need to be able to deploy 20, 30, $40 million into a single vehicle.
Yeah.
To be honest, I can count on one hand the number of employee ownership vehicles capable of receiving a check of that size. And so right now, the institutions who are active are those first movers, are those same folks who
Yeah.
frankly were investing in solar in 2005. It's the forward-thinking insurance companies. It's the
Uh-huh.
foundation. It's the folks who see that spread to risk and say, hey, this is and also the double bottom line story and say that this is where we want to be putting our money. And the rest of the market, they're the tip, but the rest of the market will follow as there's capacity to do so, but it's still relatively early days in this kind of next iteration of what is a 50-year-old model, in the United States.
Yeah. Yeah. I guess when you put it like that, it makes absolute sense. I mean, look, a lack of managers, lack of vehicles focused on that employee
And just a
ownership.
lack of corporate demand. Yeah, I mean, there
Yeah.
are a lot of just a lack of understanding of what this capital could even do, for example, inside the balance sheet of an established
Mhm.
ESOP, right? Because, for example, and this is something that we talk a lot about at LS, we want to grow through acquisitions. We have a very active pipeline, but right now the types of capital available to us are fully amortizing bank loans. And
Yeah.
we're a large, sophisticated, scaled entity, and in the private markets or in kind of the regular ownership structure, we would have access to equity, we would have access to mezzanine, we would have access to all sorts of things that, that ESOPs traditionally haven't accessed. And so when we look at scaling ESOPs, I think the types and variety of capital that are in there, can really change both the outcomes for the companies and for those plan participants, for those employee owners, but also the ways that capital is deployed in the space. And to be specific about what I'm talking about, a lot of these companies have 15 to 20% cost of capital. That's their implied cost of capital. Well, there are these debt securities, these mezzanine firms like an Elevate Capital, like an Apis and Heritage, a Lafayette Square, like SBICs, for example,
Yeah.
who are looking for returns that are very compatible with that. And to the extent that the equity in these businesses is owned by the employees, and they're not really in a position to contribute more because that's not the nature of their equity ownership, that creates an opportunity for example, junior capital to come in and provide that growth capital in a way that looks somewhat different than a traditionally financed company, but is still, again, there's positive spread to risk there, right? Because we're trying to earn 20% with our investments and their capital is at 12. And so that works,
Yeah.
so I think the ability to even deploy capital into large, mature, established ESOPs is frankly just as big today as it is in the ESOP formation space. And so, but again, it takes education. You have to educate the executive teams of these companies.
Yeah.
You have to educate the market. You have to educate the investor base about the nature of those investments as well. And so, it's still very, very early days.
Yeah, man, it's super exciting. As I said, again, the way you articulate it really sort of paints a really sort of big opportunity ahead. Like for those people who are able to move beyond the first movers, it is a fantastic place. I'd like to sort of just change tack a little bit and talk go a little bit deeper on the Southeast acquisition
Yeah.
capital story. Because how is it that you're trying to drive, like, and solve sort of, you use employee ownership to solve the challenges around the silver tsunami, the
Yeah.
Southeast?
Yeah, that's right. And so, so it very much what the origin of Southeast very much was a silver tsunami play.
Yeah.
So my partner and I, so Jim Ward is a longtime friend. He's an investor, 15 years of experience in private equity and the capital markets as well. And so we were just talking about opportunities, about the landscape, things that we were mutually seeing. Yeah, and he said, hey, there's a lot of these great small businesses that trade at relatively low valuations. And these are just really interesting opportunities to buy and build companies over the long term. And so we started looking at different models of doing that. We initially thought about being the first, kind of like search fund incubator in the Southeast, because that was still
Okay.
like a slot on the bingo card that was available at that time. In 2017, I want to say there were maybe 50 search funds or something, and today there are 500. And so I think that number alone, or that observation alone, is important. In that, over that time, ESOPs went from 200 to 200. And so, so we have this model in the search fund, which is, kind of has a lot of energy behind it, is dynamic, it's growing. It's already 2.5 times the size of the ESOP market, which has been around for 50 years, which is not growing, which is not as dynamic, which is probably, I don't know, a little more, I don't know, comfortable. Or it's a great community. I've met so many great professionals in the ESOP space, but it is a little sleepy. I don't know, for lack of a better way to put it. Like it
I've
hasn't.
never voice. There's lots of voices, but it doesn't have a megaphone, right? It's
Right,
not sort of
right,
talking like search funds are. So, but back
exactly.
in 2017,
Yeah.
you're talking about potentially search fund incubators. Just looking at other ways to really sort of attack that. Was employee ownership a part of that thinking at
So
that point in
again,
time?
it goes back to that big bang, right? And so we're doing a deep dive on search funds, just as I learned about Mondragon, and just as I learn about Pete Stavros, and I say, hey, I think there's a way to draw a circle around all of this. And because it also, when I looked at the search fund market, it felt like, frankly, duplicating the same system that we already have. In that, if you look at the investors in the space, they're all wealthy, they're all MBAs, they all come from finance, and they're backing highly educated, elite MBAs, 85% guys. And it just, and everybody's, and these investors are earning excess returns. These searchers are earning excess returns. They're buying and flipping these family held businesses in 3 to 5 years. And it was like, damn, this feels a lot like the old way of doing things. And
Totally.
I think,
It's a private equity move down market.
right, exactly. And so it's like, well, I don't really think, taking that short-term private equity playbook and applying it on Main Street is what's going to get us to where we want to go. And so we said, listen, I think there's a way to take this model, use what's good about it, and use some of the enduring characteristics and some of the successful characteristics, and just do a quarter turn and apply it, with an employee ownership strategy. So, when I look at the ESOP market, and I look at, for example, when I look at the growth of search funds compared to the relative stagnancy of the ESOP market, I think it comes down to two things. ESOPs have been an incomplete solution, in that when we look at these family businesses, when we look at these silver tsunami companies, what they need is both an ownership transition, but also a leadership transition.
Yeah. And
ESOP
cultural trend.
solved for the ownership transition while ignoring the leadership transition. And that is not a complete solution for these, 60, 70-year-old sellers who not only need to sell their business, but also want to stop working. They want to retire. They need to, have somebody replace them. And ESOPs have been much more successful upmarket, even though it's so much more competitive from private equity, from strategic, because most of those businesses already have that professional layer of management in place. If you go up to a 30, 50, $100 million business, you're much more likely to find, sure, there might still be some founder influence, still there might be some family influence, but you're also going to find a professional layer of management who can take the business forward in absence of that seller. If you're below 30, that is a lot less common. So
that's definitely sort of one of the,
they just
we
aren't
saw that
spending
challenge a lot in the UK. Like the existing sort of models to transition to EO were very much focused on the benevolence of the existing founder, right? Not only in terms of providing capital, in terms of providing that large seller note, but also a huge amount in time.
That's exactly right.
And people just don't you talk about those older sort of boomer founders. They don't have the energy, nor probably the knowledge to sort of create an ownership culture within their businesses.
No, that's exactly right. And I think, if I had to put make a guess as to the number of benevolent sellers, it seems to be about 2%, right? Because that's about the carrying capacity of employee ownership to date. It seems to be about 2%, 200 a year out of 10,000 business transitions, 2 million businesses out of 100, 120, however you want to do the math. It seems like that number is 2%. So how do we get above 2% with something that is such kind of an intrinsically good idea, so intrinsically bankable, so good for the workers, so good for the community. So, it's just good for the sellers.
Yeah.
And so you just need to make it easier for them to say yes to. And in our assessment, it's combining that ownership transition with a leadership transition in the way that search funds have successfully done that. And then also by creating a different set of incentives, which allows you to expand the addressable market of ESOPs. And by that, I mean, historically, ESOPs have been quote unquote sell side led. And to me,
Yeah.
that was a little bit of a funny nomenclature and somewhat kind of distinct from the traditional capital markets. But, by that, I mean, there is a cohort of ESOP investment bankers who call on owners of businesses to have them sell to an ESOP. And so they are that financial strategist. They lead that transaction. They lead that transition. They help them arrange the financing. They help kind of smooth things out. Okay. But if you're that banker and you need to generate X number of revenue to pay for your team, to pay the house, and to earn a living, and that there are only 200 deals a year, that you yourself are probably only going to be able to do 2 or 3 deals a year. And so that means that you have a relatively high bar for the type of transaction that you can take on. The minimum fee at many of these ESOP investment banking firms basically price out companies below, $30 million. It just isn't worth their time to do that, because that's not what their business model is. And so then the question is, how can you change the incentive structure to make it make sense to pursue ESOPs in businesses that are $15 million, $10 million, $5 million, $3 million now? And is there a way to do that and participate in a part of the market which is a lot less competitive, where multiples are a lot lower, and where these sellers have fewer options and a real deep need, for succession planning that doesn't happen in businesses of 20, 50, 100 people. And so, there's this, I think there's so many bad lines of thinking that exist in the ESOP space. But I think one of the worst is that ESOPs don't work for companies below X number of people or X number of millions of dollars. There is definitely a bottom to that, but it's not the 500, 200, 100 that is typically quoted. I think it's about 20. I think it's 20. And so just the single opportunity of forming more 20 to 100 person ESOPs and starting that perpetual ownership structure at a somewhat lower base, but growing it aggressively, having an incentivized team in place, having a young, hungry, CEO leader in place to grow it over not 3 to 5 years like a traditional search fund, but 20 or 30 years like a long-term steward of capital. You start your compounding just at a somewhat lower base. But as you look out, 10, 20, 30 years, the outcome can be just the same, which is hundreds, if not thousands of employees and a whole lot of wealth being created for the folks who are there, along the way.
Well, mate, you've laid out the argument for that sort of ability, or that, and the argument for the need and the opportunity of going down market. But how are you guys executing that at Southeast? I mean, you've talked a little bit about obviously sort of those two legs, combining ownership with leadership and aligning incentive. I mean, what does that look like on a day-to-day basis?
Yeah. So first, it's kind of that chicken or the egg, right? Do you find the business or do you find the operator? Do you have a person in mind and you're looking for a business for them to run? Or are you looking for the business and then just assuming that you'll be able to drop that operator in when you find it? I would say, in this first transaction, in the transaction that we did with Art and Associates in Atlanta, with Jeff Easterling as the CEO and Elevate Impact Capital and Noelle St. Clair and her team leading that deal. But we did it, we found, I guess, the chicken first. I don't know exactly how that analogy will work.
Which one's which?
Business. We had the business and it was a relationship that we built over a number of months.
Yeah.
And we're getting close to going under LOI. And by pure happenstance, in my inbox, I get an email from Jeffrey Easterling saying, "Hey, I'm based in Atlanta. I'm a former Army, Cal Berkeley MBA, McKinsey, just check every box. And, I'm on a search, but I want to stay in Atlanta. This is where my family is. I want to build a business here. We're not interested in moving. I see you're in the Southeast. Should we talk?" And I said, "Jeff, we should definitely talk." So we got together. He flew up. He was in Nashville, a week or two later. We had a great meeting with Jim, and we just made kind of fast friends. And we realized that we saw that we were seeing the world and the opportunity similarly, and so we went forward with that opportunity. I do not think that every deal will come together like that, in the future. But what I will say is we have kind of a dual strategy, and I think really the key here is actually that operator. In my opinion, there are probably fewer correct operators than there are businesses, to be honest. I think that is actually the scarce asset is that operating talent. And
Yeah.
so we have kind of dual strategies where we are looking to build both kind of regionally centric ESOP holding companies, which are going to be more diversified, but based around kind of a geographic area. And the logic there is that first off, that's what people want to live, right? I mean, this prospect of these national searches and a kid who grows up in Colorado who does his MBA in the Bay Area goes and buys a business in, Akron, Ohio. Like
Gorgeous.
I just, like, don't believe that. You know what I mean? I don't believe that that is a recipe for long-term success. I think what you should do is if you want to buy a business in Akron, Ohio, I think you should find one of the many talented operators in Akron, Ohio, who are already there, who already have relationships, who already have networks, who maybe have already run a P&L, maybe have already managed 50 or 100 people, and they should run that business. And then with that platform, maybe build a regional holding company around that, employee owned, Akron based, Atlanta based, Chattanooga based, whatever market you want to pick, and then kind of leverage those relationships and kind of those natural synergies in similar or even disparate businesses, but build it for the operator that way. Or the other strategy would be to find sector specific leaders and kind of execute that more kind of traditional private equity style industry thesis, where you're rolling up a particular industry, you're leveraging, kind of that industry experience. And that will be kind of an inherently more national strategy, where it's a maybe a holding company, but of similar industries or similar businesses in related industries with kind of a national focus. But either way, there's a very really strong story to tell for that next business in. And so again, you need to find, that the first platform and the right person to operate it. And so, we are looking at those searcher types, those traditional searcher types. And we're also looking at, those experienced operators, either in an industry or in a geography with kind of an inherent right to compete, and an inherent ability, either based on their experience or their background or their natural networks, to build high growth, high impact, kind of compounding business in their chosen lane.
Okay. So, mate, let's there's a couple of things I would like to press in there a little bit further, but I just want to sort of take a little bit of step back. I mean, we talked about, like, with the team at Elevate, like, and you talked about that acquisition of Art. I mean, Elevate provided that sort of mezzanine debt. I mean, what does it look like? How do you guys show up in terms of, like, the structure of the deal? Like, what is it that you're providing as well as the searcher?
Sure. So we'll start with the searcher proposition, and we can talk about the deal because they fit in. And so, our thought all along was that we had an opportunity to offer a more attractive search package than what those search incubators offer. And so by that, I mean, search incubators offer in a partnered search, up to 15% equity, and, but you have to go anywhere. And as soon as the business is doing well, you're going to get pressure to sell it. And so there's a lot of talk in the search space, the private equity space, about holdcos, about long-term, about permanent capital. Well, the best long-term hold permanent capital structure that exists in the capital markets is an ESOP, right? You have no pressure to sell it. You can build and you can compound capital into perpetuity. It's a truly perpetual structure. And so, from the start, we say, listen, you're building a day one holding company. We are never going to pressure you to sell this business because it is structurally set up to refresh itself, to recycle its capital, and to remain in the structure into perpetuity. This ESOP can outlast every single one of our operators if we manage it well, and we layer in, new talent and think about long-term sustainability. So, I like to say that ESOPs are forever. But, De Beers hasn't given me a cease and desist yet. But your podcast has a little more distributions. That letter might be the letter might be coming. I mean, the thought is to build these permanent structures, and so we're offering these searchers effectively day one holding company structures, which is kind of the holy grail of that search space.
Yeah, it's super unique. But I think, like, as you talk about the traditional search space, even though they only have 15%, like with a lot of the sort of aspirate that you talk about, those accelerators and all the content out there, it's all about obviously the exit that they're able to get, or as they're about to be able to do that roll-up strategy and sort of build into a bigger platform, which leads to better outcomes for a lot of the times for these searchers when they're successful. How does that align with your proposition for searchers?
So it's a somewhat smaller percentage of a much bigger pie over a much longer
Yeah.
period of time. And so, the search fund space is oriented around these 35% IRRs are the thing that everybody quotes. But a multiple of capital, even if you're making 35% for 3 years, is like 1.5 times, right? All you've done is you've succeeded in churning the thing and generating 1.5 turns. Okay. Well, if ESOPs and the folks at Stout did a great analysis that showed ESOPs outperformed the S&P 500 by 500 basis points. And so if the long-term return on the S&P 500 is 7%, that means the long-term potential return on ESOPs is 12, which by the way is about what you'd expect based on, the equity risk premium of small illiquid companies. Right? And so
Yep.
I would expect a 12% return from a illiquid small cap portfolio. And empirically, that's what ESOPs do. And so if instead of thinking about 35% for 3 years, you think about 12, maybe 15% even for 20 or 30 years,
Yeah.
that is a huge number, right? I mean, that number becomes many, many multiples of your search fund exit in year 3. And sure, maybe you do another bite of the apple, whatever. Maybe you put together this whole series, but you're paying taxes all along the way. And there are all
Yeah.
sorts of justifications that, and by the way, that is not creating a better system. I would take one 30-year run as opposed to 10 3-year runs, right? And if we're talking about the impact on you personally, frankly, your lived experience, on the impact of the company, the impact of the workers, the impact of the owners who sell you that business, the impact of your investors. That
Yeah.
one 30-year run is so much better for everybody. Yet our system is oriented around, these sprints, get in, fix it, flip it, and it's that short-termism that's frankly killing the economy. And so, it just orients to a different outcome. It orients to a different horizon. And I think what it does is it creates a much better enterprise for every person involved. And so
Yeah.
that's effectively the
Absolutely.
pitch to searchers,
Yeah.
so
No, I love
that is the pitch, right?
Very
And so then we do, you say, then what's the offer to the sellers, right? Because it's
Yeah. And the deal structure. Yeah.
multi-sided marketplace, right? You're matching talent with the opportunity. And so on the seller side, it's funny how many sellers we speak to that have considered ESOPs or they thought about it and, maybe they had an
That's
advisor
interesting.
don't do this. Or maybe their advisor didn't see a way for them to make money in it. So they said, don't.
Exactly.
Like, or maybe they looked into it and they said very rationally and logically, like, wow, this is complicated. Like there's a lot here. Who's this trustee? What's this valuation? Oh, I hear there's ERISA. That's a bad word, and like, all of these reasons to say no. And
Yeah.
so our role is to basically internalize that complexity. And so when we talk to a seller, when we talk to that seller's advisor, we say, listen, view us as any other buyer. We are going to give you a term sheet. It's going to have cash at close that looks similar to any buyer. It's going to have valuation that looks similar to any buyer. We are going to put an ESOP in place. We are going to do that. We're using our own capital to
Yeah.
hire that firm. We're using our own capital to put that ESOP in place. Your net proceeds will be no different. And even if you're eligible for 1042, perhaps even better than a dollar for dollar offer from any other buyer. And so, and it's like, yeah, it might take a little longer because there's kind of an extra stage of diligence there around the trustee. But in my opinion, there's so much hand wringing in the ESOP space around fair market value. And because the way that these transactions come together historically is the seller hires the person that they then negotiate with. And that makes for an awkward conversation, right?
Totally. Yeah.
And in our instance, we are a purely motivated buyer interested in paying as little as possible. And oftentimes we're in auction processes where there's a whole order book where the trustee can go back in and look at the orders that came in and say, wow, there were 10 bids on this company. This is where Southeast winning bid landed. Like we have a market. Like we don't need to like synthesize a market. There is actually a market here. This business was for sale, was a part of an auction, and this was the winning bid in an auction. So that is the market by definition.
Makes that first
Also,
valuation like it's not required.
from an incentive standpoint,
Yeah.
too, I mean, I don't want to pay $1 more than I have to, right?
Yeah.
Because that's just more effectively debt of one form or another between us and the employees and our equity value creation. And so I think it creates a much more transparent kind of negotiation structure. Of course, we need to then go take that to the trustee to get it. They need to validate it, right? It doesn't remove the need for the valuation. It doesn't remove the
Okay.
need to prove to ERISA that this was adequate consideration and fair market value, that this transaction was done at fair market value. But it helps, right? So then there's a further negotiation with us and the trustee, with the trustee and the company about kind of landing on that final price and structure. But the deal arrives relatively full baked, which is kind of unique in the
Yeah.
ESOP.
Absolutely. I mean, it's an amazing value proposition. As I said, it removes the need for that benevolent founder to figure it out on their own.
Right.
Like, hey,
Right.
look, here's the capital. So, I mean, what's your capital stack? Like, I mean, are you guys doing this with? I mean, is it coming in debt? Are you guys doing it in
Yeah.
sort of equity in the business? What does it look like?
So to be clear, our business is most akin to like an independent sponsor.
Okay.
So an independent sponsor is somebody who leads a deal, who basically puts a transaction together, and then also is responsible for value creation post close. And so our role in the transaction is that of an independent sponsor. And then post close, we take seats on the board and we sign basically a 10-year agreement. And our equity basically pays out, in the long term, in years, we'll say the medium term, in years 6 through 10.
Okay, so after you've paid down the debt, that sort of that free cash flow then transitions to cashing out your equity.
That's exactly right. And the senior lenders like that, right? Because we are a highly motivated party that sits behind them. And
Yep.
effectively, our job there, first and foremost, is to pay off that mortgage.
Okay.
And so what they have beyond a traditional ESOP, where the team is, the trustee team and the insight that comes from the trustee, and then a management team basically running an ESOP for the first time. What we add is a layer of ESOP experience where we can come in and we say, listen, we are going to help the CEO, who's oftentimes a first time ESOP CEO, because there aren't that many repeat ESOP CEOs out there. To basically, first off, do the deal, implement the culture of ownership, work on paying off the debt, build what it means to be employee owned for that business, bring in resources from the industry to help affect that, pay off the debt. And then now we have this platform to make of it what we will, to take in the direction that we think that it should go, to take in the direction that leadership thinks it should go, take in the direction that is natural and represents the most potential for those employee owners. And so, because also we're not there for 20 years or 30 years, because that's also might be suboptimal, right? Like there's going to be a time at which they're going to be like, okay, guys, we got this, and maybe 10 years isn't even the right term. I don't know, and so that's some of the innovation that we're working on, is like, what is going to be the right term, for us to be involved. But I think it is definitely longer than that senior capital. And I think when we talk about building holding companies and kind of using, kind of harnessing the power of long-term compounding, it does take time, right? Because you need to get the balance sheet in the right position. You need to get the organization in the right position to be able to execute, those follow-on acquisitions and to build kind of these diversified holding companies, which in our opinion is kind of the highest form of this ESOP structure. And
Man,
so that's our goal in the transition, is that of sponsor. And for that, we receive some SARs, as incentive equity paid out over, 6 to 10 years, but very much aligned with the employees. I mean, there are some structures where the capital stack can get too tall, and that can leave employees without as much as maybe they could have in a different structure. That's not the dynamic here, because again, our motivation is to keep that capital stack as short as possible and get that equity value accruing as quickly as possible. And we participate in line with the employee's equity. And so it's perfectly aligned, it's perfectly linear, and it's a way to really orient around the ultimate goal, which is creating wealth for these employees.
Okay. And so as you think about that, like you talk about independent sponsors. So, I mean, I'm presuming you guys aren't doing this off your own balance sheet. Like you are getting investors in for these.
Right.
Okay.
That's exactly right. So we are funding the deal costs, though. So what we do fund is that we do hire the trustee. We do hire the valuation firm. We are on the hook for broken deal costs, which are not insignificant. and is a very real form of risk capital, right? That could be multiple six figures in any transaction,
Yeah.
even a small one. And so that is the form of kind of risk capital that comes from Southeast and Southeast balance sheet. Now, when it comes to the deployment capital, when it comes to actually doing the transaction, we have a couple different structures. We have what we call kind of that traditional searcher model, where we use the SBA and seller debt effectively to do a transaction up to, say, maybe $10 million of enterprise value. Because the
Yeah.
SBA will typically lend up to $5 million. There might be another million or two on some kind of accordion feature that some firms will offer. And then the seller note will bridge the rest of that. And so we could have a situation where you could have, 5 million from the SBA and 2 million from the seller, 5 and 3, 7 and 3, whatever. But you can get up to about $10 million with that structure. As you get beyond that, then our capital stack looks much like a traditional levered ESOP, where there is
Yeah.
some kind of conventional regional lender, offering, amortizing debt, 5 to 7 years, and then the mezzanine providers. And so in the transaction that we closed with Art and Associates and Jeff in Atlanta, we actually did kind of a hybrid of both of those, in that, we ran into some unique challenges in financing that deal. And I'm not sure how much you covered this with Jeff or with Noel, but I'll share my side of the story.
Yeah. Great.
And so we had lined up financing with the really great bank and an SBA lender, that an ESOP lender that also has a very active SBA product. And so it was a great fit. There's a lot of alignment, but we ran into two challenges. First, it was the government shutdown. And so we were targeting an early October close. And if you recall, the government shut down on September 30th. And so we were not able to get our application in line in front of the shutdown. And so that threw off our closing timeline. Additionally, and we came to find out that a major issue in getting that application in was changes to the SBA program around citizenship. And because the business had a couple of green card holders, there was kind of an extra level of diligence that was being requested of them, which we did not feel was appropriate, given, for example, that they didn't even know the transaction was happening. And so if out of nowhere their owner were to say, hey, we need to submit your visa and your green card
Scary.
by the SBA or loan application, they were like, what are you talking about? And so that was an obviously unworkable kind of unintended consequence of some changes at the SBA, which to my understanding is there's now being some work done to clarify, citizenship verification
Yeah.
applications based on percentage of ownership in a way that would exclude ESOPs from that requirement, which is kind of, I think, an unintended outcome of
Yeah.
some SOP, but anyway, so our plan for accessing the SBA in that transaction did not work. And so we found ourselves a week out from closing with no capital. And so I had just a week before that, I'd spoken with Noel and Doug Schaefer and Kyle Kostis over at the Wood Forest Elevate team. And I said, well, they just raised a fund, their pilot fund. They want to deploy it quickly. They want to get in the market, demonstrate their pipeline and raise a follow-on fund, of size in the space, which I know they will do. And I hope that will be happening soon, and this year, and so I called them up and I said, hey, I have a deal that, it's ready to go, and it might fit your, fit your criteria. And so they jumped right on it. And I think from that call to close, it was 50 days or something. I don't even know, but
Wow.
they were so easy to work with, so quick, so thorough, and it was just, but also we were just aligned, from the start.
Yeah.
And so we ended up doing our first deal with the senior capital being mezzanine, but it almost kind of goes, and because we couldn't, because their fund has a structure, has a mandate, that they need to stick to. And so they weren't able to duplicate the terms of the SBA in terms of rate and everything, because it's a different product. But what we picked up was a somewhat, kind of more permanent, non-amortizing piece of capital, somewhat more expensive because that's the nature of mezzanine. It was completely understandable. But also some of the amortization features were actually even more favorable because that type of security doesn't amortize. And so you pay your interest, but the principal stays there. And so what that does is, or especially early on, that frees up more cash flow potentially for acquisitions, definitely to de-risk and build cash, as immediately post-close of what tends to be a very highly levered transaction. So that, that cash flow flexibility, we actually found really attractive, even though the, kind of the headline interest rate was a little bit higher than what we were
Yeah.
looking at, but really not all that materially so. And so it was a really great piece of capital, excellent partners, and we were just really fortunate with the way that it all came together. And that's, I think, just another use case, and then that's an example of the way that capital, even with its quote unquote, historic mid-teens return, actually fits in perfectly into these structures, and these
Yeah.
structures accommodate them really well, because when you buy a business at 3, 4, 5 times cash flow, the intrinsic yield on that is 20%. So you can 20, 30%. And so you can handle your only piece of capital in your stack having a low double digit return, because there's a positive spread there that
Yeah.
works. And again, it's spread to risk. And so, the lower your multiple is, the more you can handle, a somewhat higher cost of capital. Because by the way, equity costs you 25%. Equity
Yeah.
costs you 30%. Equity costs you 35%. And in these structures, the equity is held by the employees. And so that's, that's the virtue of it. And I think that can't be lost, when people talk about, financing options and the types of capital that are available. We can't forget that we're competing against 25%. And so, there's a lot of opportunity to deploy all sorts of capital into these structures.
Yeah, mate, it's super exciting and really eye-opening, I think, for me and a lot of other listeners. There are other alternatives to be able to solve like those sort of big challenges around capital and and effort and time, competency that's required to make these transactions. Look, and there are so many other questions that I'd love to be able to dig into, sort of around sort of the sourcing and how you diligence these companies differently than your prior life. But I want to be really mindful of your time. So we may get you back on at a different time to continue that conversation. But before I let you go, I ask everyone a fast round of questions. Right? Yeah, ask you 3 quick questions and you offer a quick response. How does that sound?
Let's do it.
Okay, so who is the leader that you most admire in employee ownership?
I'm gonna piggyback off of one leader who I really admire, Eric Strickland's answer, and I'm also gonna say Pete Stavros. I think what Pete has done to grow the space in just a really authentic way, in a way that is impacting thousands and thousands of people and creating billions of dollars of wealth. I think the work that he's doing is kind of catalyzed, I think, this next era in the space, both at the large cap end, but also at the very small cap end. And so I think there are a lot of folks here who owe a debt of gratitude to him.
Yeah, well, based off your big bang, it makes absolute sense. Secondly, what is your favorite resource on employee ownership?
That's got to be the NCEO. I think the work that Corey Rosen and his team has done. Lauren Rogers is doing a lot of great work around the acquisitive ESOP space and bringing together, ESOPs that are looking to grow and kind of use the vehicle to grow through acquisitions, and just the convenings that they put on and the folks that they bring together, and the information that they share. I think it's excellent. I'd say a secondary, in addition to this podcast, which is excellent, would be, I think, Mark Hand's newsletter, I think
Love that.
more newer. I'd encourage them to Mark Hand is professor at, I think, UT San Antonio, somewhere in Texas.
Yeah, and it's called The Stakeholder. I'll put a link to that in the show notes too. And then finally, what would you say to a business owner who's sitting on the fence regarding a transition to an employee ownership model?
Yeah, I just think that they don't have to go it alone. It's so complicated that they don't need to learn this whole other thing, kind of when all they're trying to do is exit their business in a way that's going to create long-term sustainability and benefit their employees. So, there are partners, look for partners, and there are so many great partners all over. I don't, this is about growing the space, and whether it's one of the traditional sell side bankers, whether, trustees are phenomenal resources, work for so many great trustees. There are, the lawyers. Sean Matthew at SES is this phenomenal kind of all-purpose athlete in the space who just, he understands the legal side, he understands the structure side, but he understands the finance side better than almost any attorney I've ever met. So there are just so many great resources out there. Just find somebody find somebody you trust, and just know that there is a solution, to that will allow you to sell your business, exit, get on with your retirement, get on with your next phase, in a way that rewards your employees and create something that will will last for a really long time.
Brilliant. Awesome. So, Michael, where can people go if they want to follow your story across Southeast, 40 million owners, and 3LS?
I would say, LinkedIn. I mean, I have a couple things going on, so I'm probably a little busy, so I'm not, but LinkedIn.
Maybe you've got any hair left. Are you sleeping?
My partner at 40 Million Owners, Mike Brady, does a great job, posting both from his account, but also from the 40 Million Owners account. 3LS has a great marketing team. They're sharing a lot what we're doing, kind of across the space, and our growing portfolio of businesses on the professional services and human health side. So I'd say those are the two places to find me, and also reach out via the website at Southeast if you're interested in searching and being an operator of an employee-owned holding company.
Yeah, fantastic. Well, I definitely hope this podcast brings a couple of people knocking on your door. So, Mike, thank you so much for your time. Thank you for bringing your sort of huge passion and also innovation to this space. It's super exciting to see some different solutions that are coming to make employee ownership more accessible for more people. So thank you very much for joining us in the Alternative Exit.
Thanks a lot, Andy. It was great to be here, and thanks for all that you do in
Cheers, mate.
getting these stories out. Thank you.
Thank you.
We hope you enjoyed this episode. If you want to continue learning about employee ownership as an alternative exit, head across to abettermonday.me for additional links and resources. You can also make sure to subscribe or follow along in your favorite podcast app, and be sure to leave us a 5-star review.